What are clients investing in when they're buying the KKR Credit Income Fund?
Clients are getting a little bit of both our KKR's public credit business and KKR's private credit business, which we think is pretty unique. So they're allocating to really two strategies: our Global Credit Opportunities Fund, which is in the public space, which is really our best risk-adjusted returns we're seeing across all the traded credit markets globally. We pair that up with our European Direct Lending Fund, which is a directly originated private credit product to middle market companies across Europe. Much more higher income focused, but collectively with a downside protection. So it's a pretty unique product because you're getting both sides of KKR's credit business, the public side and the private side, and meshing that together for an income product with downside protection.
The difference between a loan exposure and a traditional kind of high yield bond exposure. And I know in the domestic market, it's still something investors are kind of getting their heads around, the concept of, trading loans, etc. Could you maybe talk us through the portfolio's positioning between those asset classes and why you're, for example, leaning towards loan exposures at the moment?
In summary, we're seeing a lot of interesting opportunities across both markets. We're more heavily weighted towards the loan market with a combination across the syndicated loans because we're seeing some yield there. And one of the things we're worried about in the credit markets is this price risk and gap risk, which you have more from the high yield market from outflows and daily liquidity vehicles.
You guys have been very transparent with your NTA and throughout the entire process. We saw it, in the depths of last year's kind of COVID crisis go sub $2, I think, or very close to it. It's now rebounded back towards $2.50, slightly above that. However, the share price continues to slightly linger, and it's almost about 10% below that. What initiatives is the team undertaking or has already undertaken to rectify this gap and to hopefully support the share price in its catch-up of the NTA?
It's super important to us to make sure we narrow that gap. And ultimately, I view this product as an income product where the investors and our partners get comfortable that we're able to deliver a consistent income and consistent performance. And for the most part, if we can prove through time that we can deliver that, hopefully that discount narrows. A couple of things: we have been doing some share buybacks, which shows our support for the product and belief in the product. In addition, we just recently switched from quarterly distributions to monthly distributions, which I think will go in effect in August. So that should lead to a little bit more consistent income. And if you look at what we're delivering on an income basis, it is pretty attractive, particularly relative to some of our peer funds out there. And then finally, it's going to be more transparency. It's communication, it's transparency about what's in the portfolio. It's doing more of these types of discussions, and we're spending a lot of time looking at ways to get more in front of our partners and our investors. The more you hear from us, the more you get comfortable with our process, our underwriting, and our performance, that will naturally narrow down the discount.
Thanks so much for your time today, and we'll hopefully talk again soon.
Thank you so much.